Hey guys, this is Eric from Mindful Trader. This video is going to be about the 20-year backtest results of the trading strategies that I use at Mindful Trader. Before I get to those, I want to point out the disclaimer URL that's on the screen. If you're not already familiar with the disclaimer, go check it out. Just punch it into your web browser. It helps make sure that you understand exactly what the risks are, not only of trading, but with using my specific service here at Mindful Trader. So check it out. Now, the backtest of my trading strategy. So Mindful Trader is a stock picking service that has two different kind of offerings, I guess I would say. For one, I post my stock picks, and so subscribers can just simply follow the stock picks if they want. Or I also teach the trading strategies behind the stock picks in case you want to learn yourself and develop your own trade expertise that way. So it's a form of education that you get to do what you want with it. Every one of my trading strategies that I use is based on backtest and stock market research. And so basically everything I do is based on this research that I've done over the course of several years. And basically, I don't like to use gut instinct to make trades. I like to use data. I want to know what happened historically, how many times has this trade set up, how many times may it have worked well in the past, or how many times may it have not worked well. I like to use history as an indicator of how likely a given trade strategy is to perform well. And that's what I mean by backtest specifically. So when I take a given trading strategy, and when I say a trading strategy, I mean, a trade that has very specific rules to it, where, the entry and exit are defined clearly. Actually, I wrote algorithms. I wrote code to define the trading rules, and then I went and I applied it against a 20-year period. Why 20 years? Well, the last 20 years, as of the time that I'm recording this, had a bunch of different market environments in it. And so I like to look at a 20-year period to make sure I'm capturing all sorts of different market environments and that those are factored in to the performance of any given trading strategy. So I take a trade strategy, I define it clearly, and then I go back in history and I look and see how could it have performed over the last 20 years. And that is my backtesting approach. And what I've found is that lots of strategies that I hear maybe touted from other either trading professionals or trading services, I went and tested them. Anything that I knew how to write the code or could figure out how to write the code to then define a trading strategy and backtest it, I did it. I mean, I've done thousands of different backtests of different trading strategies. And what I found is that a lot of them don't show profitability in backtests. In other words, like I will take the trade strategy, I will take a given stock or security of some sort, and I will look and see, okay, if this exact trade strategy, the way I defined it, set up historically, how could it have performed? And I look back at history and I see, okay, what are all the times where this trade strategy set up based on the rules that I have? And how could it have performed in each of those instances? And that's what a backtest is. And again, so many of the trading strategies that I've tested don't show a profitability in backtests, which is really interesting. But, I've been doing this a long time, and there certainly are some that do show profitability in backtests. And every trade that I make is based on a strategy that I know in backtests shows strong profitability. That's the only way I'm willing to trade. I only make trades if I know the backtested history behind the trade strategy. There are some limitations to backtests, though, that I want to tell you about. So with a backtest, I'm careful to say how the trade strategy could have performed based on backtests, because backtests are not live trades. I'm looking back at history. I'm looking at where did the price move. I'm looking at data and seeing, wow, okay, what did the price point hit this? Where did it go from there? And I'm looking to see, did it go up and did it reach the profit target that was defined by the trading strategy? Did it reach the stop loss? And there are some limitations when you go and you look back into history. Yes, the price, according to the data, shows it did reach these various points to trigger an entry to the trade and to trigger an exit from the trading strategy that was defined for the back test. But there are things that may not be able to be accounted for properly just from that data. And an example is a liquidity event. So let's say the market is crashing hard, and the price is going down so fast that people can't even get their orders in fast enough to get them filled. Like the price is just moving so fast, you can't get the price that you want when you're trying to execute a trade. There's just slippage all over the place, and you even though you look back at the data and it shows, okay, the price started at say 100 and then the price shows it went down to 80. You don't know within that range. Let's say your entry trigger was at 90. You don't know for sure that you would have been filled at that price of 90. You just don't know. There's no way to know definitively in a back test because we don't have the data to tell us that. It wasn't played out live, so we don't know what our real fill would have been. And so for all we know, it was a very volatile moment in time, and the price could have just been pounding downward, and you kind of may have ended up with a worse price. So that's an example of a limitation with back tests. And ultimately, they aren't live trades. So everything that I say about back tests is hypothetical. I didn't trade these trades. I'm just taking a trading strategy and I'm looking back at data over a 20-year window and seeing how could the trade have performed based on the data that I'm seeing, based on the price data I'm seeing. So that's important to understand. And as always, there's just no guarantee of the future. No matter how a given strategy performed in backtests, it doesn't mean that it's going to do well in the future. And even if I've been trading this live for 20 years, that doesn't mean it's going to do well in the future. There's no guarantee of what's going to happen in the future. Another thing I want to point out is that I favor trading strategies that have raw edge. And what I mean by raw edge is I mean that the entry or exit doesn't have to be too precise. There's kind of enough raw edge for whatever reason with the trading strategy that the entry could be a little later. It could be a little earlier. The exit, you could hold for a long time, or you could hold just for kind of a quick gain. And kind of no matter which way you run the back test on it, it shows profitability. Those are the trading strategies I love. And those are the ones I trade in my live portfolio that I use for the stock picks for this service. So again, if there is some slippage on some of these market events, then maybe it's accounted for, at least partially, in the fact that these are swing trades that last for a week or longer. Nevertheless, there's limitations with backtests, and it's really important that you understand that and know if you join this service and you either follow my stock picks or you learn the trading strategies on your own, there is risk. There's just no way to tell for sure exactly how these trading strategies will perform in real life. So let's get down to the results of the back tests. So I already have it on my screen here. There's a page on the website that shows it. The median annual return is 181%, and the median account drawdown is 25%. As you can tell, I go big. That's what I'm trying to do here. So this trade, this stock pick service is not one that's designed to be a moderate, investment approach. Admittedly, you can change your position sizing to drastically reduce the amount of risk exposure you have. But my approach, at least, and you don't have to do what I do, you can use the education I provide in whatever way that you want. But what I do is I go pretty big, and it's because I know that this is an investment where I'm taking a bigger risk in exchange for the potential for a bigger reward. So for my assets, my personal wealth, I have some of it that I have set aside to be very safe. There's some of it that's maybe perhaps more of a medium risk, And then I have this one portion that's just like, I'm willing to take a big risk to go for something that could be potentially a home run. That's what I use for these trades. This is the higher risk bucket. And you can tell from the results here, that's what I'm trying to do. The drawdown is noticeable, but the return is also noticeable. This, for me, this, for my taste and the types of things I look for, this is the exact sort of investment I would be looking for if I had kind of a high risk class of funds to invest. That's why I do it. That's why I invest it with my own account. So let's get down to the year by year breakdown. I think that's helpful. It's lower on the same page here. And this shows every year how it looked. And I'm going to, oh, that's a little too big. You can see here, I want to point out a few things. So for one, there is a lot of variance in the results. I mean, yes, overall, it looks pretty chunky, and it is, but there are some years where it didn't do so well. So here's one right here, 2002. It actually took a loss that year. And that was a year that was a couple years after the dot-com, bubble burst, or perhaps it was still considered part of the dot-com bubble burst. And it was a 4% loss that year. And so I want you to take a moment and think about what that means. And it can be very hard to live through periods of losses or drawdowns, especially if they're sustained for like an entire year, like 2002 was. So I want to point that out. I just want to make sure people know what it is that I'm offering and know what the journey might look like along the way before they pay money and sign up. Now, as you can see, there's some other years that are in backtest, they were sensational. So that means those could have been really profitable years if those held true in live trades. And so that's pretty exciting. That's, of course, that's why I'm here. That's why I'm making these trades. I now want to point out the drawdown. So drawdown, I want to make sure you know what a drawdown is. A drawdown is how far your account balance goes down from its peak value. And this can be, I want to give two examples of how it works. So let's say that you start out with $10,000 in your bank account. And right when you get in and start trading, you lose $1,000 immediately. That would be a 10% drawdown because your account balance would have gone down to $9,000. And that would be therefore 10% lower than its peak value. Okay, so that's how a drawdown works. Now let's say though, you started with $10,000. You then immediately made another $10,000. So now you have $20,000. And then your account goes down to $18,000. That too, at $18,000, you'd be said to be in a 10% drawdown. So even though you have $8,000 of profit, that's still considered a 10% drawdown. So that's how drawdown works. It's kind of like from any given point in the year, what's the lowest that the account went down from its peak value? And you can see that varies a lot as well. And so that's something to be aware of. So let's see, there's one year here where in back tests, it looks like it had a phenomenal result of just an 8% drawdown. And that was 2009. But in other years, the more kind of typical years, you'll see it's in the 20% range. And I'm telling you right now, if you've never lived through an account drawdown in the 20% range, it's serious. I mean, it's heavy and it's hard to live through. And again, I would say that's probably the most challenging part about this trading service is living through the drawdowns, because all sorts of emotions come up. Intense feelings of perhaps fear, anxiety, anger could come up, and it's hard to live with those feelings. And I use mindfulness to work with those feelings. And you can see there's some years, in fact, the year 2020, which is last year, I'm filming this in 2021, last year had a 39% drawdown. That's intense. So if, again, you may even want to stop and close your eyes and really think about what amount of money would you put into trading strategies in this risk profile, and what if that amount went down 39% at some point? How would that feel? It's intense. So if that's too intense for you, it may mean the service isn't right for you, or it may mean you need to dial down the position size relative to what I do. So if you cut your position sizes in half, then the backtest results would be cut in half, both on the return of the backtest and the drawdown. And so, for example, instead of a 181% drawdown, if you took half the position size on every trade that I posted in my stock picks, then the backtested median annual return would have been 90% roughly. And the median account drawdown would have been 12 or 13%. So, if 39% max drawdown is in backtests is just too heavy for you, just dial back the risk. So this doesn't have to be that risky, but the trade-off is expected return. So the back-tested return for the trading size that you're using goes down as well as the risk. I want to also just point out, I know I've talked a lot about risk, but I feel it may help to just make this point, which is that in my mind, the way, I have a background in economics. In my mind, you rarely, if ever, can get a bigger return without taking on bigger risk. They kind of just go hand in hand. And of course, I'm trying to get the best returns I possibly can with as little risk and as little drawdown as I can. But there is a trade-off there, and there's really no way to escape it. And that's important to understand. So you can dial back the position size, and that's no problem at all. It just means you're also dialing back the potential reward, and it may be the perfect trade-off for you. I don't know each of you individually, so I don't know each of your risk preferences. Only you know that. And so you have to make the decision of what sort of position sizing to use, and whether that is the right amount of risk and the right potential reward. Okay, I want to also, I guess since I'm on the topic here, I'm going to just bring up the position sizing page at Mindful Trader. So positions, it's mindfultrader.com/position_sizing.html. And there is a description here of how I position size in case you want to do what I do. A lot of the, a big factor in the backtested results is this compound position sizing that I do. So it's definitely worth checking out the position sizing page if you haven't already. I have a link to an Excel file you can use where you can determine exactly how I would position size if I had your account balance for any given stock pick that I make. So that was a lot. I just got a lot out there for you guys. I think that covers everything. Yeah, I think that's everything. Feel good about it. If you have any questions, you can email me anytime, eric@mindfultrader.com. ERIC@mindfultrader.com. Thanks, guys.